Hey, 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 welcome to another episode of Deal Makers. I'm very excited for today because I am joined by Mr. Shawn Lieb of SRS Real Estate. Got a ton to cover today as usual. We'll try and pack it into about 25 very valuable minutes for you. We're going to be talking about franchises. We're going to be talking about sale leasebacks. We're going to be talking about site selections, COVID, what happened post-COVID deal making, some of the concessions, rates, site selection preferences, a lot in store. Let's see if I can bring Shawn in live. Here we go. Mr. Lieb, welcome to the program.
Thanks for having me.
We are like the Shawn squared. I got to congratulate you on having probably one of the most handsome names I've ever heard and spelled the right way.
Shawn and Shawn, at your service.
The Shawn Squared program. Okay, so my friend, for anyone who doesn't know you, I would love for you to take 30 seconds or so just to give us what you specialize in today, but your background leading up to that too, so everyone has some context for what we're going to be talking about. Take it away.
Sure. So I'm born and raised in Phoenix. My family's been in real estate for the last 30 years, and started with my grandpa who had a nightclub out here. Dad's in residential, and my uncle works in the residential multifamily space, and led me into real estate today. And it started with doing open houses for my dad, and coming out of college, did some internships and ended up working for Cushman & Wakefield, working for the retail division for the entire team, working on capital markets, landlord leasing, and tenant rep. So working for that whole deal, and ended up going to SRS 4 years ago, and have branched off running my own business here and growing the client list.
Love it, love it. And for folks who don't know, SRS is a little bit unique in that you guys focus on one niche, one vertical. What are the advantages for your clients because you guys just do one thing, which is retail?
Well, it's important to focus on one vertical. In the retail space, we focus on the landlord leasing, selling the properties once they're fully leased, disposition for retailers if they have excess box space that they have closures for. We're selling those for them and looking at the trends and repositioning of the properties for those clients. Yeah, just a full service company that covers all facets of retail.
Yeah, well, and it always kind of gives me peace of mind. It's just like you guys are absolute specialists from top to bottom at the shop. It's like you do one thing really, really well. And I think most brokerages are covering almost all the major food groups. And so that's something that in my mind differentiates SRS from, all the other options that are out there. And I'll give you a quick plug and testimonial. For those who don't know, I met Shawn at a couple of our shopping center conventions, but right after I closed my Tucson Albertsons anchored shopping center deal, he brought us a Jackson Hewitt lease in record time that just immediately jacked the value of the shopping center. And so, you've had a soft spot in my heart ever since. And I think every time I drive deals around town, I see so many of your signs. It's a good sign. So a little shout out to you and thank you for that. I'll always be in debt for it.
Appreciate it. I think we had that while you were in escrow.
Yeah, that was cooking in advance. One of my favorite things is bringing a tenant to a deal like in our back pocket. What a terrific way to add value. Maybe you'll get into that in a little bit here. But you brought something really interesting up to me earlier, talking about COVID, kind of coming out of COVID. The world's getting back to normal, but you touch so many deals on the landlord rep and the tenant rep side and owner user side. I feel like you get a great sense of what's happening for both and some of the trends there, what you're seeing with rates, what you're seeing with concessions, free rent, TI allowances, sites. So I would love for you to spend a couple minutes just kind of going through maybe what's changed from 12 to 18 months ago versus what it's like today.
Sure. You're seeing a lot of tenants not being afraid to relocate out of their current spaces, and that's one thing I've seen on centers around in Central Phoenix, for example, of about 20 different listings, and that allows me to kind of see what's going on in the marketplace. But if tenants are looking around to relocate, it's because their landlord didn't give them breaks during COVID. They're looking for a better deal. They're looking for concessions at a different shopping center, a better lease term. So, that's one trend we're seeing on relocations, tenants repositioning themselves to have a better situation for themselves.
Yeah. Wait, so when you say better lease term, is that longer? Is it shorter? Is it better rates? What do you mean by that?
Better rates. Typically, you have better flexibility for a tenant to sign a new lease with a new landlord because that's found income for them. But for the tenants to get better terms, typically they need to sign a longer term lease to get that concession up front, whether it's free rent, TI reimbursement, a break in the rent year 1 or year 2. Typically you see about a 5 to 7 to 10 year lease from these tenants.
It's interesting. I've started to have more and more startup concepts, kind of entrepreneurs and business owners who are opening their first brick and mortar location, and they don't know necessarily, the typical deal structures. What would you share with someone who's looking to open their first location? Like, expect to sign deals for this long? Can you expect to get free rent with it? What types of rates? Maybe just very quickly explain some of the triple net costs and how all that works for someone who's not familiar.
So tricks for new businesses, and first off, congratulations getting out of your 9 to 5s. It's a huge risk to jump over that. That's a huge trend that you're seeing with individuals leaving their jobs to start new businesses. That's been helping landlords fill up a lot of the vacancies with these new concepts. Some tricks for the tenants, depending on the credit and financials for the tenant. That's what the landlords typically like to see. I would tell them, there's a good amount of bargaining chip to do a longer term lease. If your financials are not that strong or not as strong as your competition, increasing the deposit is something that I'm seeing. Not giving in on all the free rent, doing more of your build out and putting in your own capital improvements instead of asking the landlord to do that work is helping these groups get in there and get their spaces that they want.
I like that, because if someone has an unproven concept, like as the landlord, they're taking more of that risk, right? And so it certainly makes me want to sign a deal, because what do I have to lose? If they've got a security deposit and they're fronting most of the build out costs and that concept goes under, and I can still repurpose that space. On the flip side, if I'm putting 50 to 100 to 150 grand into someone's build out, they're unproven. All the risk then is on the landlord. So I think as a tenant out there looking for space, it's possible to do, but just keep that in mind. We're looking at that whole global picture, kind of underwriting it like a banker would.
Sure.
I think I cut you off earlier. You were going to get into a little bit of the site selection criteria. I think some of the things that, like hot categories, right now, are there people that are, kind of exploding in growth, and those that are kind of changing or adjusting their business model? What are you seeing there?
For site selection, it just depends on the concept and who their target audience is. For example, if you're going to go to, kind of B, C type of Mexican food operators, you're looking for a high density and Hispanic population. Maybe there's a bracket of financial average household income that you want to see to be successful in those areas, depending on what the product is that they're selling. So there are certain ways to go about it. Like, we have a research team in house that does these heat maps around the valley, behind us here, that'll show pockets of high density areas of Hispanic population, or if they're looking for a 50 to 70,000 average household income, we show the heat maps on what areas are better to go in than not. And for the high end retailers, they want the shopping center traffic. We're gonna pull in tourism numbers. We're gonna pull in all kinds of different numbers for them to be successful to do that background.
Yeah, makes a lot of sense. And we're able to lead with so much more data now than I think we used to be able to do even just a few years ago. I don't know a whole lot about sale leasebacks. So if you want to kind of go 101 with that and you're seeing more and more and more of that. Real quick, how does it work? What are the implications for either landlords or business owners? Take it away.
Well, first up, I'm working with a lot of different franchisees and also working on the investment side where buyers are looking for, 15, 20-year leases to purchase and put their money. On the franchisee side, if you're going in to find a site and you're building your own product, you have the ability to sign your own lease and sell that to the investment market. So, say they buy a property for, $900,000 and, they want to build or buy an existing building, to get to a profitable number, they're going to need to sign themselves a long-term lease at, 120, 140,000 a year to, make a spread of, call it 3, 4, 500,000 up to $1 million per property. So you're seeing a lot of these franchisees buy their own real estate, either build or buy existing. And, that allows them to make the capital on the real estate side that, helps them expand their business model and get more locations.
So rather than owning it themselves, they'll sell it off, realize all that cash, that liquidity, be on the hook for 7, 10, 15-year lease. But now they've got 500,000 to $1 million to then plow back into their business, open up additional locations, use that capital, however is going to be the highest and best use. Am I understanding that right?
Yeah, absolutely. Yeah, and this is the same thing with local business operators as well. If they're buying their own building, they have the ability to lease back and sell their own building and their lease interest to make some extra capital and either make extra money and spend that wherever they like you said, or expand their presence in the market.
And you feel like you're seeing more of that happening now than previously?
I'm seeing if the tenants are well capitalized, they're able to do that. Not everybody is in the situation to do that, and they're leasing property, as they were before. But some of these businesses that have been making money and been profitable, are looking to own their own real estate. As I'm not a lender, but there are favorable terms for groups to purchase their own buildings. If they're 51% owners or more of a property, they seem to have better financing terms with these banks.
For sure. Well, and they can get in very light, right? SBA 10% down in some of these cases, super good leverage. Let me dig a little deeper on that. You've heard like both cases, right? Some business owners only want to own, some prefer to lease. Draw the distinction between the two, maybe pros and cons of each in your experience.
And preferring to lease versus
buying their own real estate. Yeah.
It just depends on, what's important to them. And, if they're able to do their write-offs on buying their own properties, owning their own properties, it's definitely important for these groups to own their own deals. If they're leasing property, it's not as much liability. So, they continue to do what they know, what they're comfortable doing, and that's what we're seeing with these groups.
Okay, cool. Should we switch gears to zoning?
Sure.
I will admit that it's not something that I've paid a ton of attention to because I haven't gotten into crazy uses. It's just been more, traditional retail or office type uses. So, in Phoenix, it's C2 most of the time. But, I would love for you to give us a 101, 102 on that. And, what are the implications for investors or for landlords or for tenants? Take it away.
Sure. Yeah, typically you see in the C2 zoning for most traditional retail, different cities have different zoning designations, what you can and can't do on the properties. It's important to go in if you're buying a property, if you're under contract, and, know what kind of uses you can do on the property. So, C2, typically you can generally have most uses on your property, including medical, general retail. You can't necessarily do residential, but you can do, any type of uses there related to retail. So when you're looking at a property that is C1 zoning, for example, I have several different landlords that have that zoning designation.
Mm-hmm.
You're limited on not being able to do certain uses, such as bringing in a bar and relocating a neighborhood bar into your property. You can't have primarily sales of alcohol getting into a C1 property. Mm-hmm. So I had a deal over in Central Phoenix, moving a tenant over from another property. We had a 10-year lease, $20 a foot, would have added a good amount of value into the property. Get to the lease signing, and we get denied by the city because it's a C1 property, and it would cost a lot of money to rezone the property. The neighborhood behind would not be too happy about that. So just something to look into when you're diving into your due diligence. Additionally, looking at automotive, you need to have certain zoning for that. In Tucson, you need to have industrial zoning for certain automotive uses, which limits your amount of coverage and the amount of properties that are out there for those uses, which causes some problems for franchisees looking for sites.
Mm-hmm. So if I'm a investor looking for my next deal, do I do some sorting and filtering and say, hey, I just want to go after C2 or better type zoning so that I've got more options? Is there more demand there generally, or are there a lot of people who just don't even think to ask that question? I
don't think to ask it, but there's property that are operating under C1 zoning that are either grandfathered in with the uses that are already there, or there's still a good amount of retailers that are able to lease in C1. So that still is a generalized retail zoning, but it is better to have C2. It's just a flexible zoning to have, and it widens that net for retailers that you can plug in.
And then is there a world beyond C2? What does that mean? I know Arizona legalized not too long ago recreational use. Enlighten us in that whole world and what it means for you guys.
Yeah, it's definitely, it's been exciting. Watching Denver and their trends with the lease rates and property values that have gone up. That certainly happened out here in Phoenix. It just depends on every city. Every city has different requirements, what they allow. Some require C2, some require industrial zoning. And, there's other distancing requirements, for these medical dispensaries, medical cultivation sites, recreational, that can allow them and get their permits to operate their business. So, a lot of things that these groups, selling all types of marijuana products need to be aware of, and distancing from schools, churches, parks, other dispensaries. So there's a lot of distancing that needs to be present, and there's a lot of people working on these teams to find sites for them.
Mm-hmm. Help me think through how to do this the right way. If you've got a user who's looking for a space, how do you find them a site? How do you do it without hurting the rest of your center? There's probably a little bit of a stigma. Are these people always going into standalone buildings, or are there scenarios where there's some co-tenancy that makes sense and you're kind of getting the dispensary and the vape shop and the smoke shop and the tattoo shop all in one center? And it's, I don't know, is it a Sin City type center? You tell me.
Yeah. Well, it just depends on the owner. Depends if the owner has a lender that's also strict on them. And you certainly don't want to piss off your other tenants, especially if they have long-term tenancy in your property and they're paying good rents. So there's a catch-22 there. Typically, I'm seeing dispensaries going to freestanding buildings, that the real estate that they like are, high visible property. you don't see a whole lot of dispensaries going into multi-tenant buildings for a lot of reasons, and a lot of that's liability and being neighbors with a dispensary and someone breaks in on the side of your property from the other tenants. It's just, there's a whole lot of problems that can cause from that. So typically you see dispensaries going into standalone buildings or buying property and building their own. But as far as the other uses you mentioned, you're seeing a lot of demand for smoke shops and C-stores out there right now because of the legalization. So, I mean, there's a smoke shop almost on every corner, but there's distancing requirements for them as well that they need to be aware of, and every city has their own rules as well for that. But the demand, the margins have definitely increased since the legalization for these smoke shops.
So wait, you're saying smoke shops are looking to add more locations, expand?
They're looking to add more locations, and they're able to pay more rent.
Got it.
So landlords are actually looking at adding them into their shopping centers. They're bringing in bodies. Dispensaries are bringing in, customers that have a lot of cash, or they're willing to spend a lot of money because they're buying not only marijuana product, but then they want to buy their accessories to that. They have expendable income. They're using it on their medicinal purposes, so they might as well go down the rest of the lineup of your tenant mix. You're bringing in foot traffic to your shopping center. So it just depends on the owner and depends on the situation of the tenant makeup.
Yeah, definitely. Okay, let me do a little fire round with you. Like, you've shared a lot with us. It's been awesome. One of my favorite things to learn from all the CRE amazing folks who have joined us on the program here is their favorite investment. And I mean right now. So, Shawn, if you were going to write a 7-figure check to invest in a deal in the coming weeks or months, or you were going to participate, if you did a joint venture or a syndication deal, do you have a favorite right now? Something that you're saying, hey, this is in high demand, it's flying off the shelf, there's good velocity here, or there's a certain part of town, there's a certain age of asset, there's a certain size of asset. I'd love to hear kind of your strike zone, where you would want to be, and then why, so that we can all think a little bit more intelligently about our next investment together.
Sure. Well, I don't want to beat a dead horse, but anything with a drive-through on an end cap or freestanding, anywhere in the market that gets traffic, and typically I would buy these buildings vacant, and wing it after that. I mean, it depends if the numbers you buy these buildings, but if it's a $700 to $1 million building for a freestanding drive-through building, typically you can get $80,000 to $100,000 minimum on your rent plus expenses paid by the tenant. So those are safe investments, and there's maybe 6 months of lead time to lease those up. But, on the grand scheme of things, if you're going to, flip it and sell it and, take advantage of the 1031 tax bracket, as long as that's around, depending on what Biden administration wants to do with that, that's fine. I mean, 6 months to a year, you're going to hold that anyway, and then sell it or hold it for cash flow and refinance it. So, those are good deals to own. And, a lot of the other properties, the properties that you like, other groups that are looking at in the Valley are strip centers. I would love these strip centers up on the road. It's good parking, has good visibility. You get signage, put monuments, add monument signages to the streets for, improvements for an owner. And that helps your visibility. It helps your tenants out, helps you get more rent, if you're able to add more signage. And, look at these rents, for the properties. So, dissecting these deals is really important when you're looking at multi-tenant properties. You're looking at tenants that are paying below market rents. You're looking at the rest of the market, and they're paying, a couple bucks a foot more or more on rent. There's some value to address there. And, as you're syndicating more and looking at properties, you hire someone like me to look at these deals and evaluate them. And, we'll tell you if it's a good buy or not.
Yeah. Well, okay. And let me break that down a little bit further. I know drive-throughs are the hottest ticket, right? Would you be going for single tenant standalone deals, or could that be part of a 3 or a 4 or a 5 tenant little strip center? And do you have a preference one way or the other? They both fair game.
Just depends on where the rents are at. If you're talking about a multi-tenant pad building, if they're paying above market rents for the other two spaces in there, and you have an end cap drive-through paying you above market rents, you just have to evaluate if that's going to be a good play and good investment to go into. If you can't replace those rents with the other tenants and they're paying too much, and you ask a advisor if they're paying too much in rent, if you lost those tenants, that may not be a good buy. But if there's rents that are in that building that you're able to replace, and if they left tomorrow and you're able to lease that up for more or the same amount of money, those are typically good deals. End cap drive-throughs or freestanding drive-throughs, again, those are good properties.
Well, and you mentioned buying a vacant deal. I think that would, give a lot of people the willies and scare them and say, hey, there's a ton of risk there. It's speculative. Like, what if you don't get a tenant? How are you going to get a loan on that if you're going to get a loan? I'm leading you a little bit, but why would you take that risk? Why would you go that route?
It's just the feeling of the market. So if you think you can lease that up and at what rents, and you look at rental comps for these buildings, you're taking a risk, but it's worth the reward if you're able to lease it out. And, we identify these properties to lease them out and have a good marketing strategy to find the right users for them, credit wise, rent wise. And, we're able to turn these around and make them profitable for these investors, getting them anywhere from 10 to 12% return or more. Mm-hmm. They're selling these at 5-6% cap rates. So you're getting a nice spread for a lot of these groups, or they can cash flow them.
Yep. I think that was, what excited me about that business model that you just described is, your market inside and out, what tenants are looking for right now, how desirable a certain site is going to be. And so you have a lot of confidence that you're going to be able to fill that up in, 6 months versus 2 or 3 years, because there's so many people looking for a site like that. And by signing a single lease, you can double the value of a property in some cases, depending on the size of it, right? And so you go in there and you supercharge and you juice your numbers by doing it that way versus just coming along and paying, a 5 or a 6 cap for a deal that's already got a tenant and an income stream in place. So probably different buyer profile, someone who, is willing to go through that effort or collaborate with someone like you that, runs with the users and knows what those sites are and can break down and say, you know what, this site isn't going to be that easy to lease, and you're not going to get those rates that you think you are for reasons A, B, and C. And
that happens too.
Right? Okay, so awesome job so far. Thank you for sharing all those things. Let's spend another minute going into, really what your specialty or expertise is. So I'm thinking of any of the prospective clients out there, whether they're a landlord or a tenant or a user looking to buy or a user doing a sale leaseback, like who should call you or who should email you and for what types of reasons, just so everyone's clear on that.
Sure. Yeah, it's anyone really that's looking to create value. Anybody can find property and find existing returns of 5 or 6% lease, but it's really adding the value to these investments. Whether it's a vacant building, it's got some tenants in there, it's got some struggling tenants that you're looking to replace. So on the landlord side, it's hiring a guy like me to add value to the property and dissect what's going on in their building, look at different avenues on how to extend a lease, give concessions up front to extend leases, increasing the rents, and what's the long-term vision of a property for these owners. So looking at the full scope of a wide lens and saying, here's where we add the value from front end to the back end, and what your short-term and long-term goals are for your properties. I love working with groups like that because they have a creative vision, and we're able to help them out and make them a lot of money at the end of the
day. Fun question here coming in from LinkedIn. Is there really any vacant sites left out there? What's your thought on that? You're out there every day pounding the pavement, getting calls. You got users looking, that maybe haven't found a home yet. What do you think?
Just got to know where to look. So, that's the importance of having a great network for groups that, I get phone calls. I've been doing this 7 years in retail, and I've built a database of groups that, if they come up with properties, they call me to find out what their values are, to find out what they can lease things for. So it comes with longevity of being in the business, and people calling me and telling me, I have this property coming up and it's off market, and I want to sell it or find somebody to lease it. And that doesn't come with someone new in the business. It's somebody who understands what they're doing and understands what the values are that these owners have in their hands. And typically it's a good question, but there's a lack of product, and so it's finding off market deals. It's finding the right opportunities for users and what areas they want.
Yeah, well, and I think obviously there's vacant sites out there, right? We could pull a CoStar report that would probably show 7-8% vacancy across Greater Phoenix in retail. And then there's going to be certain parts of town that have a little less and certain parts that have a little more. And, a lot of filters and searches that you can do to help people look specifically for those. I know that's what, I spend most of my time doing, is trying to find those deals that are underperforming in good areas. But I think really understanding all those nuances that you got into and saying, hey, just because a site's vacant doesn't mean that you can backfill it, or doesn't mean that that's what users are looking for today. And so being able to marry up, that supply with that demand is really, where so much value creation can happen. Because
it's gotta be priced right. I mean, if the land's too expensive or the building's too expensive, or someone came in and bought the property for $2 or $3 million with a tenant in it and they lost their tenant, they're going to try to sell it as close to their purchase price as possible, but it's not worth that anymore.
Yeah.
So, the other day you got to lease it up again to sell it to close to what you paid for it. So, a lot of these deals don't make sense at the numbers that are out there on the market. So that's another way to evaluate these deals. If you're going to go buy one of those CVS or Walgreens properties out there, some of these are still overpriced. And if you find a deal that's lowered and it makes more sense, can you split it into 2 pads? Can you lease it as is? Can you split it and reuse the drive-through? But those are the things you got to look at. But you don't want to overpay for something either.
I got a bonus round question for you that just popped into my mind. Have you seen any great retrofits where someone could fit a drive-through and they added it? Or are there certain types of buildings that you could look for and say, hey, there's enough room behind it, there's the appropriate stacking lane? I've seen a few that I thought were closed, they don't quite work, or I've got this little mini, drive-through that was a CVS that doesn't really work for a coffee. So have you seen folks doing that and making it work, where we can add a drive-through to an existing location without tearing the whole thing down, but just do more of a retrofit?
And that's the goal. You don't want to tear down a building and then build it back up to build a drive-through if you don't have to.
Yeah.
So if you have a strip center and you can add a drive-through on the end cap, say that end cap's coming available, look at how much space you have to add the stacking, like you mentioned. Typically, you don't see the drive-throughs go around the building because you have a lot of action going on behind there. You got your trash back there. You got delivery trucks coming back there. So you don't typically see drive-throughs going around the strip center building. But starting to see some of those U-shaped drive-throughs that are kind of a half moon where you're barely touching the building and then coming back out the same way on the same side. If you can have the room for a drive-through to add in, definitely look into it and see if you can add the stacking necessary that the city will approve. Typically that's the avenue you got to go.
Well, and like you said earlier, that could be between $75,000 to $120,000 in annual rents just in that one site.
It depends on the area. Depends on the functionality of the drive-through. If it's a tough drive-through and it's a tough access point to get into that drive-through stacking, it's not. You're not going to get your most rent out of your deal, but typically you're going to add some value that wasn't there before if you're able to get accessibility for people to stay in their cars and pick up their food or pick up their deliveries and have them take it out with them.
Beautiful. All right, so let me pull up, Shawn, your email here. If anyone wants to reach out to Shawn, which you should, he's done a lot of deals around town, works with a lot of tenants, has a lot of properties listed, and I think can give great context and advice to so many sites. I mean, I appreciate how many deals you've helped me take a look at before, I've written an offer on them. And, I really value your, how tight you are with what people want right now, right? It's like buying a deal that no one wants to lease doesn't do anyone any good, but what's in demand. And I think that you've got a great pulse on that, which is why I was excited to have you as a guest on this program today. So thank you again, sir. I appreciate your time, and don't hesitate to reach out to Shawn or Shawn in the comments. If you guys, watch this live or you're watching the replay, I think we'd both be happy to jump in and answer any further questions. So good, sir. Thank you for your time, and we'll
have me.
All right. Take care.
You as well. Thank you.